Mr. Chairman, I have in my hand February 20 joint letter from key mortgage and banking trade associations, which I just entered into the record, highlighting the important opportunity that exists with the modernization of bank capital standards to strengthen both financial stability and housing affordability by supporting a diverse, competitive mortgage market. Without objection, I'd like to ask that not only this be entered into the record, but also turn to Mr. Broekschmidt. The MBA has argued in favor of more clarity on the treatment of private credit enhancement, both private mortgage insurance and CRT and bank capital rules. Could you please elaborate? I know you spoke about this earlier when I was here, on how providing this clarity can help improve just overall, once again, housing affordability, because it's such a major issue before the House of Representatives.
Sure, and particularly as it relates to private mortgage insurance, if you put 10% down on a mortgage, you get 30% private mortgage insurance. That takes the risk of the bank from 90% to 67.5%. As written, this rule would make you hold capital as if your risk were 90% and you didn't have any first loss protection. So we recommend that they do include some consideration for the effective loan to value after the mortgage insurance, because it's good to bring in loss absorbing private capital that would absorb the loss before the bank. And on credit risk transfers more broadly, that's often used by the GSEs and larger financial institutions. Similarly, we support well-capitalized transactions like that to provide loss-absorbing capital to the banking system.
Thank you. Chair, I'd just like to note, I think of the last 2.5 hours, what you just said is the most important thing and should be the most important thing to members of the House of Representatives that are trying to figure out how to tackle the housing issue. And I have the chairman of the subcommittee sitting right to my left, so maybe he'll follow up on that. To Mr. Griffith, how do the revised capital proposals, particularly changes to risk weight and the treatment of trading activities, improve banks' ability to provide hedging and risk management services to producers, farmers, and maybe commercial end users?
I appreciate the question. So the majority of the risk in the futures market, or the primary tool we use is, the primary tool we use is the futures market. The majority of that risk has to flow through an FCM. And a lot of that sits with big bank FCMs. And if you increase the capital there, two things are going to happen. One, their ability to clear could go down. You could have people leave the industry, which definitely injects risk into the system. I think that's worst case. Best case is that the costs go up. If the costs go up, that's clearly going to move down to the merchants, and that's going to flow down to the producers. It's going to flow down to the end users, and ultimately flow down to the American consumer.
Very good, thank you. Mr. Baer, I just have a minute here. One concern has been addressed again a couple times. One of the concerns with 2023 Basel proposal was the lack of, I guess, appropriate tailoring, might be the way to describe it. How do the revised proposals better account for the difference in size, complexity, and business models across?
Sure. For the smallest banks, separate from this proposal, there's been a lowering of the community bank leverage ratio that community banks can opt into. There's a legacy standardized that does not apply to GSIBs but could apply to all other banks, and they have reduced some of the risk weights there. And then any bank will also have the option to opt into the expanded risk-based approach and get those better risk weights. But I would note there was another tailoring issue that's not at issue here, but which is very important, which is, in the years after the global financial crisis, there were various thresholds set for heightened supervision. There are probably more than a dozen of them. I have a chart. Those need to be indexed for GDP growth. I think the agencies probably are on a path to doing that. They've had a lot of work to do recently, but it is really important for mid-sized regional banks that they not be continued to be treated like banks much larger than, simply because the economy's grown and they've grown along with it.
Thank you. Chairman, I yield back. Thank you.